How long can housing data stay positive with the conflict in Iran and rising oil prices? My name is Dennis Wells. I am a mortgage advisor, and every single week I update my clients and referral partners on what is going on in the financial and real estate markets. Hey, as we jump in for the weekend of April 4th, 2026, let's start off by looking at the weekly pending home sales. The reason why this is important is that pending home sales provide a week to week perspective on the housing market, even though the results can be affected by holidays and other short term fluctuations. The last 6 weeks have shown positive yearly growth. However, the yearly growth did slow down last week and the week to week data dipped slightly. Weekly pending home sales usually take 30 to 60 days before they hit the sales data. Typically, mortgage rates above 6.64 really impact the data. We really would love to be under 6.25% because that has been the sweet spot over the past several years, excluding some very short term variations. So, weekly pending sales last week over the last 2 years, this year, 70,209, last year, 69,183 for 2025. Now we want to consider the mortgage purchase application data. The reason we do this is that purchase application data is another forward looking indicator. Growth here leads home sales by roughly 30 to 90 days. And last week, we also saw year over year growth, but it did slow from 12% to 5%. And we saw a week to week decline of 5%. So the increase in mortgage rates did take a bite out of yearly growth data last week. We love seeing 12 to 14 weeks of positive weekly growth. And for 2026, every week has shown positive year over year growth. For some context, here's what we've seen so far in 2026: five positive week over week prints, five negative week to week prints, one flat week to week print, 7 weeks of double digit year over year growth, and 11 weeks of positive year over year growth. Now, we do want to comment a little bit on the 10-year yield and where we are with mortgage rates. For 2026, many economists anticipated the following ranges: mortgage rates ranging between 5.75 and 6.75, and the 10-year yield fluctuating between 3.8 and 4.6. Due to the Iran escalation, we saw an intraday high of 4.48% last Friday, closing around 4.44. Keep in mind that we were sub 4% before the war started, and it took a few weeks before the mortgage rates and the 10-year yield started to take the war more seriously. But here we are, close to the peak of the 2026 forecast. Now, while the 10-year Treasury yields and interest rates have come down over this last week, in the previous week, we actually have data for mortgage rates ended the week at 6.64%, according to Mortgage News Daily. The hero of all of this would have to be mortgage spreads. Mortgage spreads remain a positive story for housing in 2026, as mortgage rates would have easily been over 7% if we had the spreads from 2023, 2024, and 2025, those with the worst levels of the spreads. However, the spreads, which were getting a little bit worse in February as yields fell, compressing the volatility on the downside, are now heading higher with the war. But even now, as you can see, we are still at better levels than we were the past 2 years. For context, mortgage spreads are the difference between the 10-year Treasury yield and the actual mortgage rate. Historically, they've ranged from 1.6% to 1.8%. Last week, they did close at 2%. But to compare what rates would be this week compared to the worst levels of the spread over the past 3 years with the 10-year at its current level, if we had the worst levels mortgage spreads in 2023, mortgage rates would be 7.75% today, not the 6.64. If we had the worst levels of 2024, mortgage rates would be 7.37% today rather, And if we had the worst levels of 2025, mortgage rates would still be at 7.18. So that we're at 6.64 is very positive. And we're always hopeful that we can get some resolution to this conflict in Iran and get some stability back in the market, which will help not only the mortgage spreads, but would also help the mortgage rates as well. So we do want to take a look at the weekly housing inventory data. Housing inventory is starting its seasonal increase. We always do get more listings in the spring as we get closer to summer, but the growth rate of inventory has really slowed from last year's peak levels. However, we are far from the unhealthy levels of 2021, 2022, and 2023. We have gone from a 33% year over year growth in inventory at its highest point in 2025 to just under 6% at 5.69% last week. In the past, inventory growth picked up amid higher rates, softening demand, and rising year over year new listings. What we are seeing from March 21st to March 28th, inventory rose from 705,000 to 713,000. The same week last year, inventory rose from 668,000 to 675,000. Now, it is important to realize that we want to get somewhere in the 80,000 to 120,000 new listings every week. We are not seeing that right now, even though inventory rose from 705,000 to 713, up from the 668, 185 to 675, 557 last year. We're still not in a situation that it is a extreme buyer's market in most areas. But let's take a look here at the new listing data because this is also significant for us. New listing data also had a slow week. We should be getting new listings above 80,000 per week during the seasonal peak months, which would be a low end of the number. Because, like I mentioned before, we would like new listing data to range between 80,000 and 100,000 per week during the peak periods, as it did in 2013 to 2019. However, for context, during the housing crash of 2008 to 2010 or 11, new listings range from 250 to 400,000 per week for several years. So new listings for the past 2 years in 2026, this week we had 67,934. Last year we had 67,855. So very similar year over year. Now, what about the price cut percentage? Typically, about one third of homes undergo price reductions before they ultimately sell, which reflects the dynamic nature of the housing market. As mortgage rates and inventory rise together, the percentage of price cut increases as people try to move their houses. But as evidence of the strength of the housing market currently, the price cut percentage is below last year at this time. The price cut percentage for last week was 34.07%. This year, last year was at 35%. So getting a little bit better. So we will see how the monthly job report data affects the market, but ultimately, we won't see stability in the markets until this conflict in Iran is over. With that, I will sign off for now. This is Dennis Wells. I'm a mortgage advisor. I hope you have an amazing Easter weekend and let me know if I can help you with anything. Have a great day.